Well, hello everyone, and welcome to today's Status Chat for Friday, August the 9th, 2024. I am Delbridge, Benchmark Realty, Murfreesboro, Tennessee, and here we go. Okay, before we get started in economics and how it's affecting the economy, as I see it, my interpretation of it, I want to send out some prayers to people of Brazil. There was an aircraft that was lost, and presumably all 62 people thereon have been lost, and we have flooding in Sarasota as a result of the tropical storm that came through there. So there are some bad things going on in the world, and we want to send out our regrets and prayers to them. Hopefully it'll do some good. If you like this content, please go to CallDelToSell.com, find the tab that says on YouTube, click it, and it'll open up a page of QR codes. There you can use a smartphone to scan and get to the YouTube page, or you can just mouse over and click it on a PC. There you'll be able to subscribe to this little button over here and click the notification bell so that YouTube will notify you when each Friday's blog has been uploaded. Thank you. Now before us, I have something that I want to talk about as best I can. It's the carry trade. I think it's what happened Friday and sent everything in kind of a tailspin. And that happens when people are expecting a zig and we get a zag instead. And I think that's exactly what happened in this case. Now here, this is from Trading Economics, Japan inflation rate, and it really looks pretty good. It's an inflation rate that we would like to have. 3.3 is pretty steady, and it drops down to 2.8, 2.6, 2.2 is the lowest they got to, and it came up a little bit, and it's hanging around 2.8. Well, it's a sticky inflation, and it's undermining the yen, their domestic currency there in Japan, and that is a problem. Now, we look at foreign governments and how their fiat currencies work, whether they be the yen or the yuan in China, the German Deutschmark, the UK has the sterling, pound sterling, Canadian dollar, whatever. Each of these nations is highly tied to the United States, and one of the ways is through what we call carry trade, and I'll explain that. But let's look at this. Let me zoom this out a little bit. And we want to look at what things look like for the 5-year period, get a little more historical perspective. Now what we see, we were riding in Japan around 0.5%, less than 1% for a long time, right up until the virus was released and everything got shut down. And we see that there were actually deflation involved here in Japan, and it started to rise. It comes from down here, from negative 1.1% to a maximum of 4.3% or 5.4%, and it's sticky. It's very sticky for a number of years, and this is watering down, the inflation is watering down the buying power of the yen and hurting the people of Japan. And so what was happening is we had an expectation. People all expected that when you have economy slowing down and you're in recession, that you lower interest rates because that spurs the economy on, but it actually destroys your domestic currency. And what we see from 10 years ago, we see that we did have a longer period of time out here. In 2015, the world were having some level of economic issues, and pretty quickly things kind of settled out. At least they weren't losing their domestic buying power. Now in America, specifically in our area of Tennessee, we're in the automotive belt. There's a little kind of oval shaped area where we have a lot of automotive industry. Japan did a lot of investing in the United States. So if they could get a low amount of yen, low interest rates, and take it to America and get growth out of it, it makes good sense. It's good. It's a good use of leveraging when you can take a little bit of interest and get a return on that. So let's take a look at what America's inflation rate has been, because we like to spend some money and we are deeply, deeply in debt, and we have it right here. This is also from Trading Economics, United States inflation rate. And you see we've hit, it doesn't look too bad from this perspective, but remember in 2022, they redefined how inflation was going to be calculated. They rebalanced it and changed how it was measured against what time period and what year and how it was measured. And our inflation rate, they say, is down to 3% as of June. Now, we don't have July's number on Trading Economics, but it is there. So let's zoom in a little bit, and we'll take a look at what our inflation rate looks like over 5 years. Because I'm going to contrast what Japan did, which makes sense. They are in recession, and they have done something to improve things. I believe you can Google it and find Japan in recession and find that they're in recession. So we were having our normal, typical about 2%. It's a little higher than what it should be at 2.5% in 2020. It was about where it needed to be, below 2%, above 1% up to the election. And then, of course, the virus was released and we dropped down. We never saw our deflation like Japan saw, and it has been going up until we revised how we were going to measure it. Now we've come back down, but all of this is really putting a burden on American households, particularly the lower third of America is suffering, and I don't know how much more they can take. I see reports that we are at massive record of debt, household debt. A lot of it is on commercial loans, the credit cards, the things of this nature. We've got to get this under control, and we're not under control yet. So what we saw was a little bit of a bad report. We saw unemployment rise, which is not a good thing, generally speaking, and we saw inflation is not changing in a good way, along with the jobs report as far as the number of jobs created. And we saw within that, if you go back a few episodes, you see that certain areas are taking a hit. We actually saw some job losses or a contraction in certain areas. According to the ADP report, we see that some professional services have taken a hit, manufacturing has taken a hit, and there was one more that off the top of my head I can't remember. We can go back and look at that. But we see some actual job losses, but on the total, we were still putting jobs on, just less than what they expected. And then the drum beats from everybody and their dog out there barking and hollering, hooping and hollering, drop the rates, because there are a lot of rich folks out there that's leveraging money the way many people in Japan have leveraged the yen. And they weren't planning on having rates go high, and they've got to refinance those. That's nothing new. We've talked about that before. But when we look at what Japan had for an interest rate, let's go back and look at the screen. We see that they have actually been negative on their interest rates. I believe you'll find that Germany had done the same thing. Both of those countries are in massive debt as a result of their fiscal policy. Well, let's take it back for some perspective. Let's go back 5 years, and they're still at below zero. They haven't changed rates in a long time. So people get in their heads that rates will never go up. And it's kind of what we did in America. When rates went down, people enjoyed it. They were able to buy bigger, fancier, nicer houses. They built bigger, fancier, nicer houses. They remodeled older houses, making them fancier, but not necessarily larger. Sometimes there was an expansion or whatever. But they got into that, and they're bound by how much money someone would loan them. And then when the rates rose and it cut into the price that they could pay, then we started to see some adjustments. Well, let's go back and look a little more. Let's take it to 10-year. Well, it goes back to before 2015. You see what they had. They had zero interest rates, and they couldn't lower them below zero. Oh, but they could. And we looked at that previous slide. When we looked at Japan, we see that at 0% interest, where they were still having issues. So to keep the economy going, they dropped the interest rates to below zero. And this is not a good economic decision to make. So what happened last week is they had raised the rates again. So this is signaling to some that rates are on the rise because they have to save their domestic currency. It went up only 0.1% from minus 0.1. That's 0.2%, not even 0.25%. And that shocked a lot of people. They rose it again. They rise that rate again, and people were having some issues. So if we look at that, that's not terrible. But yet their economy is still in recession and the yen is losing value. So now we get into the concept of carry trade. If you live in a country that's not the United States and you have the ability, like in Japan, to borrow money at essentially no interest or minus interest, and then you can buy an American bond that it pays maybe 3% or some small amount, but it's more than negative zero. You can then, when that debt comes due in Japan, if you're American, money has come through, you can then pocket the difference. Carry trade. So we're doing it in the exchange rate. We're having the differences in the valuation of the yen and the dollar. If the yen is low and you can buy dollars and dollars are going, you can pocket a little bit of change. Now, in March of this year, the Fed announced that would be the shutdown of the BTFP. It was a year-long program, and what it was set up to do is to help cash up some banks. And the way it worked is they were able to get some money at a cheaper rate than maybe what they should have. The idea was to take that cheaper money and then turn it into the economy, keep the economy going. But what a lot of people did was an American version of what Japan was doing, except they were doing it with dollars. They were borrowing cheaper dollars, not putting it into the economy, getting a type of asset that would allow them to, when it came due, they'd pay it off and they'd tidy a little profit out of it. And so it didn't do what they were trying to do with that, so the Fed shut that program down. But if you go back to December, we heard the drum beats. Oh, we're going to get a cut. The Fed is pivoting. The Fed has pivoted. We're going to get a cut. And the Fed had said we're going to do three, at least three, and then maybe three, and then three, and starting in Q3. And it didn't meet their expectations, and people kept believing it's right on the horizon because of the media telling them we're going to get a cut. Now, is that good for us? I don't really think that it is. Now, Japan has their issues. They begin to raise it to save the yen, and it cuts into that carry trade. So what you see if people call notes due because they're having issues making that leverage payment, making that interest, if it's called and they say you need to pay the whole debt, you're getting behind, whatever your situation is, they sold some assets to create the money to pay off the loans, it looks like. And of course, the program buys kicked in, and other people say, well, we've set these automatic things up. We want to get this. If the price on these stocks drop down a certain amount, we want to then buy. And so we saw that drop, and then it catch back up, and then it kind of wiggled its way back up as we kind of got over our initial fears. Well, let's look at the effective Fed rate from the Federal Reserve Bank of New York. So we'll go back 3 months. All right. Still not a lot of terrible things happening here. It's business as usual. The market is doing things, even though the Fed has not played with the rates. Go back a year. All right. It's still not really changing a lot. This is the effective rate, I believe. The volume is the black line. The effective rate is down here on the bottom. That's the blue line, the effective federal rate. And if we go to all, we can see we were down here playing the same silly game. Play silly games, win silly prizes. From 2015 is when we had our little shock, but it was low for a long time before. Right after 2008, when things were crashing and people were losing their homes, we dropped the rates to save those, and some people got rich and some people lost their homes. But we see from this, we see that we too have fallen victim to massive debt because we're not having the Fed rate high enough, the cost of money. Everybody is spending money, thinking that the party will go on forever and the music will never end. When we look at our Fed rate here, we see that it's climbing up. This is the 10-year minus the 2-year. We've talked about this in the past. We always expect to see the longer term, the longer you tie money up, should pay more money. It should have more interest or more of a yield. You should get more out of it because you're not going to have access to your money. So when we have an inverted curve, they're changing the rate on the short end, on the 3 months to the 2-year. The short end is a different rate. It should pay less than the 10-year bond, if that makes sense. So here we're going in the right direction. It's not showing us that we've uninverted. This is July. We haven't got into August in the Fed's data, but let's put it in perspective, shall we? Let's take it back a little bit. I think I have and you see, this is the way we should normally be. We should normally have the 2-year paying much less, because there's much less risk because it's not tied up for a long period of time. Even the 3 months and below should not be paying that much because you're not tying it up very long. It's fairly liquid. It's not totally liquid, but it's fairly. Here's a warning sign that everybody told you: the yield curve inverted. So we're sort of butt over tea kettle when we go inverted, and we're beginning to come back out. Right? Well, let me take it back a little longer. Let's take it to 10-year. All right? It's going down. We almost inverted and we still had a recession. So being inverted doesn't mean recession, but it is correlated to a recession or possible recession. Let's take it to the max. We get a bigger picture. So here we are. One of the things we can note, though, is the warning signs people take it that when the yield curve inverts, it's a sign that we have turmoil because we do have butt over tea kettle situation. The 2-year, the short end is paying more than the long end. That's not a good sign. But when did it cross? Well, this is 78, August of 78. When did we hit a recession? Somewhere around February of 80. So that's about 18 months. Now it recovered and it went back down inverted. And then we had another recession while inverted. And now if we come over here, but you see there's a time frame from this point, from when we invert, about 80 to about 81. That's about a year, a little more than a year. That's the Reagan years when they had to correct it. We went around pretty well until we got negative again. And of course, we had if I can get that peak, that was in March of 89. And when did we have our recession? In August of 1990. So you see it's about a 12-month period here on this cycle. If we go down again, we hit the inversion. When the curves invert, it's not a good sign of a healthy economy. And this is again about the same period. We did it again. We got back up. I don't know which one of those you want to take as a time. I'd take the second inversion, and we have another period here. So we've inverted, and so a lot of people, a lot of economists are looking at this and saying we've had the curve inverted, which is a bad sign, but once it recovers, we expect a recession to happen sometime after when we go positive again. Usually happens. Now, a lot of excuses were being tossed at the jobs report. Now, if we look at the ADP jobs report, and we look at what they said, they actually said that we had positive growth, which would correlate to the federal data, but they differ a little bit. It's a different survey, a different analysis, but they did show 3 areas that didn't look real good. So after we recovered from maybe the program buys from the carry trade from Japan, because it was not what they expected. It is a trading partner with the United States, but it's not the only one. It's not the biggest one. China is the largest one. So what happened is we started to come back up, sanity recovered, and then on the Thursday, we saw the next report, and the next report said that we're losing jobs in manufacturing, we're losing them in information. You know, we've had a lot of AI and tech stocks take a little hit, and we've seen manufacturing. And people said, see, recession, it's going to be here right now. Cut the rates, because there are a lot of people that are highly leveraged, not dissimilar to what Japan's people buying the yen to buy the dollar. So we've got a lot of people that've got perhaps billions of dollars hanging out there, plus us regular folks who know that our credit cards are high and our debt is high. And so the drumbeat gets on. But is that the smart thing to do? I don't think it is to drop the rate. I don't think that dropping the rates is a good thing. Perhaps we need to raise the rates a little bit, maybe even at least hold them the way they are, but it's a bad sign to the economy. Some people in the economy will love it if we were to see the rates drop, Fed rates drop, but it's by pattern of Fed behavior. They wait too long to raise them, and once they get them raised, they'll drop them too late and they'll plummet. So a lot of interpretation will be that we're in a terrible economy, we're in recession, and they're going to drop the rates, and they'll drop them very, very, very quickly. If they drop them precipitously, that's a bad sign. That I believe that will tank the stock market and not make it stronger, because everyone will be finally saying we feel validated in our belief that the economy is crashing, when we may still be into 2025 before we hit a real recession. Now, we've had sort of a recession light for several years now, but we've been still chugging and plugging along fairly well. Now, each of these jobs reports hits a little bit differently. All right, now we have the employment situation, and within that we actually have the home survey, and we have the business survey. They're measuring different things, and they can give different answers as a result. Now, what I'm looking for September, the first week of September, we have the next JOLTS due. Now, I like the household survey to a degree because it is surveying consumer side. And when you flip to the other side of the BLS reports that we normally get on jobs, that's on the business side of things, and they do measure things differently. So I think the leading indicator isn't on the business side. I think it's on the household survey side. But the JOLTS is a little bit different, and it doesn't come out every month the way we kind of expect it to. So the JOLTS, we'll flip back over to it. The JOLTS is put out also by the BLS, but it stands for the Job Openings and Labor Turnover Survey. This gives us a little bit of a different insight to jobs because it gives us study on what we're turning over. in terms of not just jobs created and not just jobs lost, as in unemployment is obviously booking jobs lost, and jobs created shows like economic activity. Those are two different things. But a turnover is a little bit different in the psychology of it, what's going on. Say you and I are out here and we're living our best life and we're trying to move up in our salary so that we have a great retirement. Okay, if we feel confident in the economic reality that we're living, if we feel like we're doing well and we're going to have lots of opportunity and we're not scared about the future, we may feel froggy. We may jump from our current lily pad to the next lily pad, which will be the next job. Now, there's risk in that for a lot of cases because we may be a well-seasoned employee in this old company that we're familiar with its weaknesses and strengths, its opportunities and threats. And then we make that leap to that next lily pad. We're the new kid on the block, and we may not have all of the insider knowledge as the new employee that we have as an old employee. So if we start to get a little bit pensive about where the future holds, we may delay leaving. But also we're looking at turnovers, which also includes people getting laid off, them losing a job and have to. So we can see in the other data, we can see if we're moving from full-time employment to part-time employment. That's not a good thing. But if we pick up a second job, a second part-time job, that still counts as a job created, and it can be a little harder to glean the wheat from the weeds. So when we look at this, I want to be careful because this is the BLS, and let's look at what we're trending. It's not particularly a scary scene to me because we can go back here in 2009 right after 2008 and we see that we had quite a bit of unemployment. So we're bringing unemployment down and we're still just about where we were before pandemic. So we're not crazy unemployment. Our unemployment, even though it may have spiked up a little ahead of where we would like it to see, it's one blip in the radar. It's not necessarily a pattern. It could be adjusted down, just like we've seen the habit of things being adjusted down when we give them good news, they want to take that news down later on and revise it backwards so they're accurate in their. But we're not doing too terribly bad as far as unemployment. So I'm not seeing anything at the current documented levels that says that we're getting unemployment out of control. So I wouldn't say that. If it were me, I would probably hold off again dropping rates for past September. Now, there are other things in the economy that might make them do that, but what we certainly don't want to see is that fast crash in rates, because that means that the Fed historically has waited too long. And no matter what they do, they're always going to wait too long. If patterns repeat, if we can trust patterns, when they do fall, it just means that we're actually at a bad spot versus still in the future. So if we go back to that JOLTS, we can look at that. Now you can pull up these numbers. Latest job openings level in June. We haven't got to July. We'll get July in September, first week of September. And we see that we're not really too terribly bad. We have 3.2 in separation and we have 3.4 in higher. So we're still netting more than we're separating. So that doesn't look too bad. Well, let's look at the 10-year, see how it looks. Again, to try to give you a visual perspective. When this was falling, it looks bad, but this is within the day. So this is misleading us. So let's take it out to the 5-day. All right, now we have the 5-day. What does the 5-day show? Well, it really doesn't look too bad over 5 days, does it? We see the little dips down here, but we recovered, right? According to the 10-year yield, we've recovered. Let's pull it up to the top. That's the 10-year Treasury. That's right. So let's put it out a little further. I moved it too far. Let's take it to the 1 month. Okay? This looked pretty scary. And we came up. Most of that. We've recovered most of this. But have we really lost much in this bond? Let's take it to 3 months. Yeah, well, it's trending down a little bit. People are expecting. They're expecting a zig. Will the Fed zag or not? Take it 6 months. Starts to look a little bit better. We're down, but we really haven't lost a tremendous amount in this, but we haven't changed Fed rates in a while. Year to date, all right, beginning to look. Here's our dotted line, if you can see it. This is where we were a year ago, all right? So we are above where we were a year ago today. Take the full year. And you see, we rose, we fell. The world didn't fall off its axis. All right. Even though we've got doomsdayers and people who bury their head in the sand, take it 5 years. This is a much better picture of how things were. So on yields, we see that yields have gone higher in 5 years. So it's not all that bad. Let's look at the cycle. We see that we're nowhere near the highest yields. And we just kind of coming off of this 20 to 15 period. We had a little anomaly and we enjoyed those low rates and it came back. Well, now what do you say we answer that second question? Because a lot of credit was given to the Kamala Crash. And the Kamala Crash, I'm not being political, but economies are driven by politics, and politics that drive the economies, drive personal economies. We can't pretend that we don't know what has happened in the last 4 years. So let's look at the pick that they have, that Kamala, who none of the Democrats voted for in the primary, they waited till after the primary, and it's given some Democrats that I know flashbacks from when they wanted Bernie. And they got Hillary with the superdelegates. So there's some uneasiness, some unpredictability going on there. And now we've got Kamala, and she's gotten credit for sort of a panic sell. So let's see if that's really in there based upon economics, because we know that we spent way too much after COVID and we're paying for it. Let's see if this pattern is repeated anywhere else. The governor of Minnesota is the pick. And without getting into individual political issues, sticking to economics, what do we see here about how the state of Minnesota's economics have been handled? It's just like everything's going on the credit card. Now we have the blue as the state debt, and then the others are everybody else's debts, the locals. And you see it's just skyrocketing out. What do we know when you have inflation, which is tied to debt, which is tied to the economy? It means that dollar goes down. So in economic terms, if the dollar goes down and the yen goes up, it affects that carry trade. But Japan has to protect their currency. Well, what if the Germans decide to protect their currency? What if our biggest investor, China, decides that they want to go operational on the American economy and they raise their rates? So they take a zig when we are expecting a zag. And we do what so many people with loud political voices pressure the Fed to drop the rate. That's going to cause inflation, which waters down our dollar, because we go from quantitative tightening to quantitative easing, we're trying to pick the winners and losers, and now we start throwing money at it. We can spiral out of control. No, we're not spiraled out yet, but we could. And now what happens to our equities market if our political scene that people are unhappy with over 4 years, if we continue that same path forward? What signal does that do to the other countries who invest heavily in the American economy? What happens if Germany pulls the Deutschmarks out and converts it back home? What if China pulls them back and pulls them back home? If our dollar goes lower, we may have to rescue the dollar, and we may be in a situation like Japan, that they're deeply in debt and they have to raise rates in order to save the yen. What if we have to save the dollar? Have we waited too long? Can we turn the ship around? Now, let's see what the Dow is doing, because we're talking about equities, the equity market. Well, this right here is year to date. Let's take it back today. I didn't reset this screen, and we see that, well, today, one day, we're rising up. We're getting positive. We're getting over some of our negativity. Take it to the 5 days. Let's see where we were. Where we dropped, we're still up. The Dow is still, the stock market is still feeling optimistic. Take it to a month. Well, where are we? We still really haven't lost. We're at 39.4. Let's call it 39.5 on Friday. Go back over here to the other start of the month, 1 month back, and we're at 39.2. So we're still higher than we were. We didn't lose anything because we didn't cash this in. If you didn't cash it in, you're not hurt. Take it back 6 months. We're still above in the stock market. Even with this little drop that freaked everybody out, we're still above where we were before. Year to date, still uphill. 1 year, a year ago to date. So here we are in August of 24, 39.5. Let's go back to August of 23, and we're at 35.1. All right, 5 year, it's still climbing up. Maximum, we're still climbing precipitously high. So what does that tell us? That currently the equity markets are still standing strong even after the little scary carry trade issue where Japan zigged when they expected to zag. But that ratio, it drops, that trade drops, and we may not get as much from Japan as a result of them trying to stop inflation in Japan. What should we be concentrating on? Should we be worried about the drumbeats of screaming voices, or should we be taking care of the families and people in America who are facing this? Even though the rate has gone down, we have not seen any deflation. We've only seen disinflation, which is a slowing of inflation. We're still losing our buying powers to this. So I would say that dropping of the Fed rate, especially if it's in September, if it's more than 0.25%, that would say the Fed is keeping on track. If the jolts comes in very negatively, we may have an issue. But if the jolts is not showing all that bad, maybe lowering the rate will cause more inflation and hurt more people across all aspects of our society, that we would be better just holding to what we have, let some of this normalize out, let's see what some of the other countries are apt to do, and let's hold to what we got. All right, well, let's wrap this up with our numbers. Hello, I'm Delbridge of Benchmark Realty, Murfreesboro, Tennessee. If you are currently unrepresented and would like to know how to compare up to 3 properties side by side and room by room, then go over to my new YouTube channel, CallDelToSell. That's 1 L and Del, no spaces. Watch the demo on Real Scout and then call me and we'll set up your exclusive ad-free account today. So we agree. Last Friday was bad. We had a surprise. Didn't look good. Then we had the ADP report. Didn't look great. That caused a little bit of upsetness, but we see we're still rocking on, maybe not because of the data, but in spite of the data. Let's see if we disrupted and had a massive change in the real estate market in the Middle Tennessee MSA. We're looking at 8/2 of 24. We had 22,493 opportunities. That decreased over the previous period. We had 40 in the under contracts still showing. That also dropped, and the ratio, energy ratio, if you put those two together, went down from 19 to 18. So if all of this is gloom and doom and disaster like YouTube would have you say, or it's absolutely glorious days like other people would have you say, we should see something markedly different this week. 8/9 of 24. We had 22,695, actually went up in opportunities just a tad. We had 51 in the under contract still showing, and the energy ratio between what's still showing and what's available stayed exactly the same. So no henny penny, the sky isn't falling. If we look at our pattern of the 10-2 and recession, it would indicate one's coming. We're not there yet. If we want to trip a recession, maybe we drop the rates really fast. We give the money to the rich folks that need to balance out their highly leveraged lives, and we have inflation that continues to wreak havoc on the rest of us people. So anyway, that's just an opinion. Yes, I think it's kind of a perfect storm of two bad things happening in the same week, close proximity to one another, but I urge you, let's not make hasty decisions until we see the first week in September, see how those JOLTS reports come in, to see how we're turning people over, see if people are failing to get froggy, failing to jump, to see if we're losing ground. That'll tell us more than this one day blip on the radar that had people screaming emergency dropping of the rate. What would that make you think? As just a regular human being like me, what would you think if we had an emergency Fed rate cut? Would that tell you that we are crashing and things are terrible? So maybe the Fed needs to just keep their head about them. We'll see you next week. Thank you for watching.